Authored by James Rickards via the Daily Reckoning. One of the questions I am asked most frequently in my global travels is what will be the cause of the next financial crisis. This question is asked by those who understand that this crisis is coming, but want to pin down the date or a specific turn of events that will help them know when to react. My answer is always the same: we can be certain the crisis is coming and can estimate its magnitude, but no one knows exactly when it will happen or what the specific catalyst will be. The second part of my answer is to prepare for the crisis now. When it happens, it could unfold very quickly. If you've been paying attention to the stock market lately, you know how quickly selling fever can spread once it starts. Just look at these past 2 days alone. We've had multiple days since October when the Dow loses several hundred points, with the other major indexes posting similar losses on a percentage basis. There may not be time or opportunity in the middle of the crisis to take defensive measures. That's why I keep reminding my readers that the time to prepare by increasing allocations to cash and gold is now. With that said, it is useful to consider the most likely flashpoints for the next crisis, and to monitor events as a way to improve one's chances of seeing a crisis at the early stages. In yesterday's Daily Reckoning, I made the case that the next crisis could begin in the junk bond market. But there are a number of other possibilities. You recall that the financial panic of 2008 actually started in 2007 with massive loan losses in subprime mortgages. Those losses caused certain hedge funds and money market funds to close their doors. Investors scrambled for liquidity to cover their mortgage loan losses. This led them to sell equities, bonds and gold to raise cash to meet margin calls. The panic was subdued in late 2007, but came back to life in 2008 with the collapse of Bear Stearns, Lehman Brothers, AIG and others. The Fed and Treasury intervened to provide guarantees and liquidity, but not before everyday investors saw half their net worth wiped out. The crisis was not confined to the US, but spread worldwide to Europe, China and Japan. Now a new loan loss crisis is unfolding. The new crisis is not in mortgages but in student loans. Total student loans today at $1.6 trillion are larger than the amount of junk mortgages in late 2007 of about $1 trillion. Default rates on student loans are already higher than mortgage default rates in 2007. This time the loan losses are falling not on the banks and hedge funds, but on the Treasury itself because of government guarantees. Not only are student loan defaults soaring, but household debt has hit another all-time high. Student loans and household debt are just the tip of the debt iceberg that also includes junk bonds. Again, as I explained yesterday, corporate debt and even sovereign debt, all at or near record highs around the world. Meanwhile, the trade war remains a great risk to markets. When the trade wars erupted in early 2018, I said that the trade wars would be long-lasting and difficult to resolve and would have significant negative economic impacts. Wall Street took the opposite view and estimated that the trade war threats were mostly for show, the impact would be minimal, and that Trump and China's President Xi Jinping would resolve their differences quickly. As usual, Wall Street was wrong. Trump's top trade advisor Peter Navarro recently delivered a speech making it clear that trade wars will not be resolved soon. He also tells Wall Street to get out of the policy process. He said, if there is a deal, if and when there is a deal, it will be on President Donald J. Trump's terms, not Wall Street terms. Navarro warns that prominent Americans such as Hank Paulson, former Secretary of the Treasury, and Blackstone chief Stephen Schwarzman may be acting as unregistered foreign agents as a result of their lobbying activities on behalf of China. This could subject these principals to criminal prosecution. Investors should expect lower earnings per share from Apple, Sony and entertainment companies dependent on the Chinese market or Chinese manufacturing to make their profits. Companies such as Caterpillar are also caught in the crossfire. Get ready for a long and costly trade war. It has already started and won't be over soon. But I've been warning for months about an even more disturbing possibility, that currency wars and trade wars can easily spill over into shooting wars. This happened in the 1930s, and it seems to be happening again. One of the most dangerous hotspots in the world today is the South China Sea. There are 6 countries with recognized claims to parts of the South China Sea. Yet China itself claims the entire sea except for small coastal strips and claims all of the oil, natural gas and fish that can be taken from the sea. China has ignored international tribunal rulings against it. The U.S. is backing up the other national claims, including those of the Philippines, which is a treaty ally of the U.S. China has built small reefs into large artificial islands with airstrips and sea bases to support its claims. The U.S. has increased naval vessels in the area to enforce rights of passage and the equitable sharing of resources. Both sides are escalating, and the risk of a shooting war or even an accident at sea is increasing. The South China Sea is mostly out of the headlines at the moment, but it bears watching as a possible catalyst for the next international crisis with global financial implications. We should look for slower growth and possibly a recession as the trade and currency wars play out. Let's hope that history does not repeat and that we don't end up in a third world war, as the currency/trade wars of the 1930s helped lead to World War II. Warnings of economic collapse are no longer confined to the fringes of economic analysis, but are now coming from major financial institutions and prominent economists, academics and wealth managers. Leading financial elites have been warning of coming collapses and dangers. These warnings range from the IMF's Christine Lagarde, Bridgewater's Ray Dalio, the Bank for International Settlements, known as the Central Banker's Central Bank, and many other highly regarded sources. Just when we think we've seen enough of these, another one arrives. This time it's the legendary Paul Tudor Jones, who manages Tudor Investment. I've met Jones. He's a cerebral yet polite and mild-mannered manager from Tennessee who has not lost his southern accent despite decades in Connecticut and an estate on Maryland's eastern shore. What gives Jones voice-added authority is his longevity in the fund investment world. He's managed through the 1987 stock crash, the 1994 Mexican crisis, the 1998 long-term capital meltdown, the 2000 dot-com crash and, of course, the 2008 financial panic. Jones knows that panics happen, but he also knows they don't happen all the time. Panics take years to build and usually have specific triggers, even though endpoints can spin wildly out of control. Jones does not treat the possibility of a financial crisis lightly, so his warning deserves close consideration. Jones warns that the next crisis is likely to be triggered by excessive debt, specifically corporate debt, which can be more difficult to manage or bail out than sovereign debt. At the same time, other gurus are warning that the next panic will emerge from the foreign exchange market, overvalued equities, or commercial real estate. Perhaps the real message is that all of these areas are vulnerable and the next crisis will seem to come from everywhere at once. That's the danger. We're looking at another debt crisis and global financial panic. Only this time it won't come from mortgages alone but from all directions at once. So let me repeat what I said earlier, the time to prepare by increasing allocations to cash and gold is now. Stock market outlook: early 2019 could be very bad for stocks. October was bad for the stock market. In October, the stock market had a really rough time. With all the selling and volatility, one could be asking, what's next? Before going into any details, it's important to know a few things. This year, October was one of the worst months for the stock market since 2008. We saw key stock indices like the S&P 500, Dow Jones Industrial Average, Nasdaq Composite Index, and Russell 2000 Small Cap Index drop to correction territory, dropping over 10% from their recent highs. We also saw a spike in volatility in the market. The CBOE Volatility Index, VIX, often referred to as the Fear Index, surged higher. At the beginning of October, it stood at around 12. By the end of October, it had reached close to 29. This represents an increase of over 140% in a matter of a month. At its core, in October, the VIX said that investors were nervous. What's ahead? Historically speaking, November and December tend to be good months for the stock market. Rarely, we see a sell-off in these months. Look at the S&P 500, for example. Since 2009, there have been only 2 instances when the index declined in November, in 2010 and 2011, and 2 instances when the S&P 500 declined in December, in 2014 and 2015. Source: S&P 500, Morningstar, last accessed November 7, 2018. Mind you, for all these instances where the S&P 500 dropped, the declines were small. So, it's possible that stocks find some support in the coming months. However, be very careful ahead. Please look at the chart below. It plots the put/call ratio. This chart may not look exciting to the untrained eye, but it's saying a lot about investor sentiment and where the stock market could be headed next. Look closely. The put/call ratio is essentially a ratio that is calculated by dividing the total number of put options by the total number of call options. When this ratio reaches 0.70, it means that investor sentiment could be turning. When it is over 1.00, it means that investors are buying more put options, betting against the stock market, and their sentiment is bearish. In early 2018, the put/call ratio stood at 0.75. Since then, this ratio has been elevated and currently remains above 1.00. This is saying that investors are bearish and don't have much faith in the stock market. They are betting against it. Stock market outlook, short-term relief, long-term pain. Dear reader, after the sell-off in October, as said earlier, it wouldn't be shocking to see the stock market find some buyers in November and December. But I have doubts about the rally we see. I am really worried, going into 2019. There are a lot of factors that could send stocks tumbling very quickly. Rising interest rates, global trade wars, a slowing global economy, and the list goes on. Sentiment indicators like the put/call ratio also suggest that bets against the stock market are growing. I will repeat what I have been saying for the past few months: capital preservation is key. It could be a great time for investors to evaluate and adjust, if needed, their long-term portfolio. Stocks on the edge of a nervous breakdown as financial crisis looms. Markets sending clear warnings that financial crisis could strike in 2019. Stocks are about to hit the end of the track. The end of the bullish cycle that started in 2009 appears to have finally found the terminal station, inaugurating a new bear market. But will this end with a soft landing or a financial crisis? As much I'd like to believe that what stocks have witnessed in November, traditionally a bullish month, is a minor correction, my realist side has all but resigned to expect the worst. One clear sign that investors are gearing up for a financial crisis, implying they've lost confidence, is that the Dow, which went up steadily from July 2018 to October 2018 and from November 2016 to December 2017, has lost momentum. On a year-to-date basis, the Dow is on the negative side. The Dow's performance chart for the past 2 years, see below, speaks 2 different languages. The first half, leading up to January 2018, rose in expectation of President Donald Trump's tax cuts. In 2018, in response to growth-curbing trade tariffs and some politically heated months, volatility has increased. Great anxiety. 2019. The chart's pattern reflects growing anxiety. Investors now expect a financial crisis in 2019. Goldman Sachs Group Inc. NYSE, GS, has advised clients it does not feel very bullish about stocks in 2019, and it should know, given that GS stock has lost 20% since a year ago. In 2016, the U.S. Department of Justice charged Goldman Sachs with a $5.06 billion fine for its role in selling subprime securities, contributing to the 2008 financial crisis. So when Goldman Sachs warns of a recession, investors run for cover. It all depends on how Trump reacts and performs when he's pushed against a wall. In the meantime, investors are being pushed against Wall Street. Rightly or wrongly, concerns that President Trump may force a constitutional crisis, forcing the Russiagate issue to be resolved one way or another before the newly elected Democrats take over the House of Representatives in 2019, have only added to the economic uncertainties. Moreover, there are signals coming from Main Street. The much-touted U.S. economy may not be as robust as many have been led to believe. As Thanksgiving approaches, opening the Christmas shopping season, retail analysts have surely started to worry that shoppers will be less enthusiastic with their cash and credit cards in 2018. In fact, some retail sales associations have produced some foreboding forecasts about their 2018 fourth quarter performance. Watch those FAANG and tech stocks. Some of the same concerns about consumer demand for the iPhones that sank Apple Incorporated Nasdaq Apple stock have spread, affecting the performance of the so-called FAANG or tech stocks. Meanwhile, investors worry that regulators going after Facebook over privacy concerns will damage tech stocks. And just as in 2000, the tech stocks, the same that made huge gains over the past years, could trigger the U.S. government to regulate social media to the point of becoming overly intrusive, causing usage to drop. This time, China and Trump's tariffs could set off the next tech/Nasdaq avalanche. Investors fear that as Trump continues to subject microprocessor makers in China to higher import duties in the U.S., ostensibly to bring jobs back to the U.S., he will price popular products out of the market. Of course, while Dow Jones serves as an indicator for the world's richest and most popular stock market, for a true financial crisis, the aversion to risk should be global. Global sell-off. In fact, the wave of sell-offs on Wall Street has both spread worldwide and resulted from global pressure. Asian markets have suffered from the latest corporate scandal. The arrest of Carlos Ghosn, chairman and CEO of Nissan Motor Co. Limited (OTCMKTS), Nsani, Tayo, 7201, and Renault SA, OTCMKTS, RNLSY, EPA, Renault, in Japan has contributed its own weight to driving the Nikkei index down over 1%. But as concerns over the world economy rise in expectation of more tariffs and trade discouraging measures, China's markets teeter on the brink of collapse as well. One clear sign of low confidence in the global economy's prospects is the oil price. Oil has dropped from some $70–72 per barrel in early October to $53.70 in November. In a little over a month, the oil price has gone from the highest to the lowest level of the year. While low oil prices were once welcomed in the West because they favored growth, they now point to the coming period of unprecedented uncertainty about the financial markets. And then there's Europe. European stock exchanges might as well have not gained at all since 2016. They're at a 2-year low. The decline has been such that investors are terrified. And when investors are scared, they retreat and hide like cats. European investors have plenty to worry about. Trump has threatened to impose tariffs on European cars, and the automobile industry still drives the economies of the biggest Eurozone countries. But as threatening as those tariffs might be, there are bigger issues causing Europeans to lose sleep at night. European investors have lost confidence because of Italy and the United Kingdom. The financial crisis that's brewing on Wall Street will spread to Europe. From there, its effects will be refracted around the globe. Italy and the UK will be the obstacles, causing the refraction. The former has decided to challenge the EU, and especially its dominant French and German leadership. Rome has dared to defy budget deficit rules to jumpstart the economy. The latter is teetering on a major political crisis, hesitating on the process to leave the EU, Brexit. Regardless, Italy and the UK have weakened European confidence in the political and monetary union's prospects. And that will encourage investors to seek shelter in liquidity, if not quite yet gold. Of course, the world stopped being an island long ago. Interconnections are everywhere, and American investors who have little care, let alone awareness, of what's happening in Europe will pay a price if they're not careful in the markets. A financial crisis doesn't need an invitation or a passport to migrate across borders. Damned if you do, damned if you don't. The EU has become one of the major possible detonators of the next stock meltdown in 2019. But the fuse reaches straight to Wall Street, passing through the Federal Reserve. The Fed's gradual restriction of liquidity through interest rate hikes will continue. Why not stop the rate hikes? Wonder investors. Stopping it now could send the wrong signal and intensify the pessimism. After pushing the need to tighten the money supply because of an overheating economy, we are told, what kind of message would Powell send by going back? Such a move would simply betray the fears running through the entire economic system, exposing them and fueling more panic than applying the hikes. At least, the markets have already absorbed the higher rates factor, even if they're going to cause intense refraction. A financial crisis often extends beyond economics. Financial crises have often marked the beginning of epochal economic and geopolitical changes. World War II, it can be argued, was the logical conclusion of the 1929 stock market crash and the Great Depression. The great economic recovery of the 1950s and 1960s in the geopolitical West benefited from the Cold War. Interestingly, apart from the inflationary pressures from the shift in the pricing of oil, cheap oil helped grace the industrial world's recovery. Until 1973 there were no financial crises comparable to what happened in 1992, 2000, and, of course, 2008. However, the financial crisis cycles do offer a hint about which stocks will best weather, even thrive, in the coming storm, the repercussions of which will last for decades. Such repercussions are rarely of the optimistic variety. Often, they include conflict and war. As I've often written on this platform, defense stocks may drop like all other stocks as fears of a crash intensify. Yet if the U.S. continues to play the role of global policeman and under Trump, this has not changed. The defense budget will ensure the big military-industrial players like Lockheed Martin Corporation, NYSE, LMT, or Boeing Co., NYSE, BA, and others will continue to run at full capacity.